Hello, everyone. Welcome to a Wall Street for Main Street podcast special. My name is Mo Dawood, and today's special guest is the CEO of Sandstorm Gold and Sandstorm Metals and Energy, Nolan Watson. Nolan, thank you for joining us again.
Well, thanks for having me again.
Great. Now, Nolan, this is Jason Burek. You were still at Silver Wheaton during the 2008 crisis. Is sentiment for precious metals as bad or worse now than it was back then?
Yeah, yes. I think that although one forgets how panicky people got during the 2008 crisis, there was a while there where people thought everything was going to zero. This feels a little bit different. People aren't quite as panicky. They are what I would describe, though, as much more depressed on average, in the sense that back then in 2008, there was this sense of optimism and hope that despite things were going bad, there was a lot of people who thought and understood this is a liquidity crisis. As soon as we've solved the liquidity problem, things are coming back pretty quick. There's not a lot of people who feel that way this time. There's people that are feeling down and out, and they don't see hope of things coming back anytime soon. That's sort of a general market sentiment right now in the commodity space.
Yeah, and there's also this belief, Nolan, that especially among the mainstream Wall Street people, the trend traders, the hedge fund guys, a lot of the hedge fund guys and the talking heads on the mainstream media, that there is no inflation, that the U.S. economy is recovering, or at least it's doing a lot better than the other economies, and that the Fed can exit its balance sheet in 3 to 5 years. So I think this is, in the short term, it's causing a lot of confusion here in the precious metals markets. What do you think about that?
Well, I think that is a prevailing sentiment right now, although I'd like to point out kind of a logical error in that line of thinking, which is when the U.S. is struggling and unemployment is high and there is surplus capacity in the system for additional production, of course you're not going to have inflation. Inflation is what happens when things are going well and production is at its capacity, and there are time and time again, it's when the velocity of money picks up because the economy is at full steam, and people are starting to worry about, quantitative easing at the same time that things are going well. And the quantitative easing is happening because they have to print because there's too much debt, and that's not a situation that we've been in over the last few years. There's been U.S. unemployment has been fairly high, and there's been lots of surplus in the system. We're actually moving into an area where everyone is so bullish on the U.S. economy, and U.S. stocks are going up so much and so frequently. U.S. unemployment is slowly but surely going down, and you even hear the Fed talk about U.S. unemployment hitting what they call escape velocity, and manufacturing is starting to take up. It's all the signs of the beginning of what could become an inflationary environment, and I find it quite ironic that right at the very time where all of the foundation things required for inflation are beginning to happen, everyone is so quick to declare that there is no inflation and it's not going to happen. It's quite funny to me.
Yeah, what you described is more demand pull inflation when the economy is roaring and the demand just keeps increasing. But it looks like a lot of the inflation that is in the system has been like that cost push inflation. A lot of the inflation has been exported outside the United States. And it's more of like a stagflation type scenario where there's inflation in certain types of things, and it's not the good type of inflation that you described. The good type of Keynesian deflation, Keynesian inflation that you described, where the economy is actually doing good and people don't mind that there's high prices because, times are much better.
Yeah, I'd be careful, though, because at the same time what's happened is that so much liquidity has been flushed into the system. In a normal environment where you have a demand sort of inflation, there is not as much liquidity that's been flushed into the system as there is today, and they've put more and more and more and more money into the system. But what you see is the velocity of money has been dropping every quarter on quarter, and so prices haven't been going up. But it's kind of like you've been throwing gasoline on a massive fire, and you've been doing it for so long, the first spark that comes along can start a fire that isn't stoppable. But you do need robust economics to do that. And there's so much liquidity in the system that I don't think if that happens, the Fed can unwind the balance sheet that quickly. And it'll just be interesting to see. I think the U.S. has gotten themselves into a really sticky situation. I'm very curious to see how they get themselves out of it.
Now, Nolan, as you know, last month gold and silver prices dropped so much in so little time. Gold prices dropped around $200 in just a few days, and silver, dropped around $5 also in just a few days as well. And I just want to get your thoughts on why that happened, because there's a lot of talk out there that this move was engineered by the central bank and the big banks. So, do you agree or disagree with that?
I generally speaking disagree with it. I think that, and I've been saying this for quite some time publicly, that what people have to watch out for when there are hedge funds that decide that they want to get out of gold, because if you look at it historically, more gold has been held in hedge funds and mutual funds and other types of funds that historically haven't owned gold. More of those funds have owned gold now than they have ever owned in the past, up until very recently. And when they decide to get out, they decide to get out quickly, and they move fast. And I think what you're seeing is a mass exodus from gold holdings of various funds around the world. The good news is that most of that gold is being bought up by retail and some of the more obscure central bankers, and it's being bought up in Asia, and it's being put into what I would call firm, steady, longer-term hands. Unfortunately, I think that this phenomenon is probably going to continue on for the next several months, potentially the remainder of the year, but eventually it will abate, and I don't think that the demand for gold is going to be reduced from the likes of Asia, and I think that in the longer term, gold price is going higher, so I would not be surprised to see the gold price go quite a bit lower over the next several months, and then quite a bit higher beyond and after that.
Now, what you just described, Nolan, is basically a dislocation between the paper price and the supply-demand fundamentals. And in terms of the actual supply-demand fundamentals, you look at the World Gold Council, and you see that demand for gold coins, bars from investors is up 8% annually. U.S. Jewelry gold demand is up 5%, which it hasn't been up at all. And then you look at the paper price, and I guess what you said is that all these short-term guys who have a lot of money have decided that they want out of the gold trade because it's not trending higher, and there's a lot of money to be made on the short side, and they can make a lot of money moving that money into the stock market then, or into the Japanese stock market chasing yields.
And that's exactly right. That's exactly what's happening.
Okay, so in terms of the bottom then, what do you think then will put the final bottom, because obviously the demand is just strong. There's really rising premiums in gold in Asia. The premiums are rising still rapidly, and there's long delay times here in the U.S. still for coins. But do you think it's going to be the production cost for the miners? Because if demand for the actual metal is still rising and people's stronger hands are buying, weaker hands are not selling as much anymore, do you think then it's going to be production costs for the miners that's going to determine the supply, the price floor of gold and silver?
I don't, actually. I think it's actually going to be the time when net liquidation out of hedge funds and mutual funds and ETFs starts abating, and just the natural, continuing, relentless buying pressure of retail and people in Asia is going to continue going forward. I think that's when you're going to see the switch. So it's more of when this current selling abates that I think we're going to see a switch. Gold's actually an interesting market in the sense that if you compare it to, say, copper, the vast majority of it, once it's produced, it is used, and the amount that is kept in inventory at any given point in time is a relatively small percentage of the worldwide annual production compared to, say, gold, which the amount that is sitting in inventory in banks and financial institutions around the world is approximately equal to 75 years' worth of production. So as investment demand increases or decreases from various holders of gold, and that gold moves from one hand to another, moves in the inventory of that gold have such substantial effects on its price that effectively the producers of gold are irrelevant in the equation, i.e. all of the gold produced in the entire world in an entire year is only 1.5% of the gold that's currently in inventory. So it has some effect. In the long term, it certainly has an effect, but in the short term, it has almost no effect on what the price is.
And one of the main battles that a lot of miners are dealing with is rising input costs. You're seeing cash costs go up for a lot of even the major, the mid-tier miners and even some of the junior miners having trouble containing various input costs like energy, labor, and etc. due to rising inflation. And if you look at the financial statement for a lot of these companies, for example, if you look at Barrick, they claim that their cash cost is $9.50 per ounce, but yet if you look at their cash flow, it's in the negative. So how is that so? So it seems like the numbers don't add up. If today gold price is $1,300 and yet Barrick is producing gold at $950 per ounce, we should expect to see some type of good profit margin, but we're not. They're actually in a negative cash flow there. So I want to get your opinion on that. Do you think a lot of the mining companies out there they calculate the production costs in many different types of way, or they, I don't say manipulate it, but they try to hide some of their production costs in their balance statement and financial statement?
Yeah, historically, mining companies have just reported what they call their C1 cash cost, which is just the variable costs at the mining level that don't get capitalized for accounting purposes. And what you're seeing is the whole industry is now moving to what they call an all-in sustaining cost of production, which takes that C1 cash cost and it adds the sustaining capital portion, which doesn't hit your operating cash flow, but it does show as an investing cash outflow. And then they also back out some of their G&A as well to come up with what could be considered a sort of variable cost of producing an ounce of gold. And I think that's the $950 to $1,000 an ounce number that you're referring to, Barrick. But what generally the industry is not disclosing is what the cost on a per ounce basis is of the capital of developing either that asset or a new asset to replace those gold ounces that are being produced. Because if you think about it, Barrick has a number of assets around the world, but they have finite lives, and eventually those assets are going to shut down, and Barrick is going to have to spend capital to build new mines to continue being a gold producer, and that's the reason their cash flow is negative right now. For example, Barrick is spending what I believe to be approximately $3 million a day every day at its Pascua-Lama operation that is not up and running, and the project appears to be semi on hold right now. Various legal issues are being sorted out, and that's $3 million a day of cash outflow that is not being counted towards the cash cost of production in any one of the assets that they have around the world. So very quickly you can see a situation where Barrick's actual costs divided by the total number of ounces that they produce is higher than that number. Their actual margin is very low, and right now Barrick has, I think it's almost close to $20 billion of debt, and that's a very risky position to be in with low cash flow to no cash flow and a lot of debt.
Yeah, Nolan, I was looking at gold and silver miners, like balance sheets and stuff like that, and especially income statements, and the profit margins even a year ago, the profit margins for gold and silver miners were just horrible. When gold was above $1,600, when silver was above $28, the majority of gold miners were not even generating over $200 an ounce in free cash flow, and the majority of silver miners were not even generating $5 an ounce in free cash flow. Have the costs really exploded across the board in labor, raw materials, energy, things like that, and grades dropped? Are those the factors, or is it something else for why the costs have increased that much?
Well, it certainly has been a substantial cost increase in almost all of the input costs in mining, and that's sort of one of the reasons that you're seeing this cost go up. Certainly it is true that more marginal assets have come online, which has further increased the average cost of producing gold, and you'll probably see with the pullback on the gold price, some of those mines are going to shut down, they'll turn off, and you'll see the industry average cost of production drop a little bit because the high-cost mines will fall out of those reports. But I think the bigger issue and the more challenging issue for the gold industry is that the significant number of the gold produced around the world is produced in developing countries, and those developing countries are just that, they are developing, and the rate of inflation in wages and other costs in those countries are going up dramatically more than the inflation that we're seeing in the developed world. And so you think of the U.S. CPI at 1.8 or 2% or something like that. There are some countries around the world where it's going up at 10% a year, and some countries 20% a year, and it's that rate of inflation that the costs are going up for these mining companies that have assets in those jurisdictions. So costs are going up much, much faster than people had anticipated. At the same time, prices coming down, margins are getting squeezed, and there are a lot of companies out there that are in a challenging situation. So what I'd encourage investors to focus on right now is finding those companies with assets that have a low cost of production, that have low debt levels, with assets in jurisdictions that don't have outrageous rates of inflation.
Now, with the rising input costs that's going on in the mining industry, one of the things we haven't, one of the reasons for that is also because of the lack of advances in technology in the mining industry. So I believe they're using technology that's still being used back in the 70s. So, do you think that rising input costs will be a blessing in disguise, and that we'll start seeing more innovation and more technology advances in the mining industry, so they could somehow mine these metals more efficiently and at lower cost? In the long run, in the future.
I think that in the long run, certainly there will be some technological advantages or advances. Obviously, the way we mine today is more sophisticated than the way we mined 50 years ago, but the mining industry is very slow to adopt dramatic, sweeping changes, and I don't see, say, over the next 10 years, any material changes in technology that would affect input costs. Over the next 50 years, sure, I think that's reasonable, but certainly not over the next 10.
Now, based on this, Nolan, it sounds like you're predicting a humongous margin compression, like you said, still that to ensue. Do you see a lot of miners that are producing right now? Do you see them going bankrupt, a large percentage? And what about the juniors? Do you see John Kaiser's 500 number being the plus or minus there? Do you think there'll be more than 500 juniors folding up?
I think it'll be less than 500, although I'm not optimistic about the success that those companies will have that don't fail. I think that there will be some companies that have managed to keep themselves working capital positive and have not borrowed money, and they're just going to sort of shutter the door and shutter operations and lay staff off, and they'll manage to keep a public listing, so they won't disappear entirely, but for all practical purposes, they'll be dead, and certainly would not be enjoyable or fun to be an investor of any one of those companies. I wouldn't be surprised to see 200 or 300 companies disappear completely, then another 200 or 300 go into a sort of prolonged hibernation. I do think, though, that this is not entirely a bad thing for the mining industry. I think the mining industry had a lot of fast money come into it, and some of that money was indiscriminate, and we're seeing some of the looser players, the poor quality assets are being shaken out of the industry, and what's going to stand remaining are strong companies with stronger management teams, with stronger balance sheets. And Sandstorm, for example, we are working very hard on continuing to focus on being associated with lower cost operations and doing deals where we've got a large gross margin and keeping a relatively strong balance sheet. And so I think that we're going to come out of this stronger than when we went into it.
We want to shift gears here and talk about Sandstorm Gold and Sandstorm Metals and Energy. So starting off with Sandstorm Gold, a couple months ago, you made a deal with Entrée Gold for one of their mines in Mongolia. And after you made that deal, the stock for Sandstorm Gold went down about 20%. And a lot of investors were worried because in Mongolia, it's considered a unfriendly place for miners, and also considering the fact that this mine is about 10 years away from production, a lot of investors did not like that. Were you surprised by the reaction you got after you made this deal?
I would say I'm moderately surprised by it. To be candid, I think that what we did is a poor job of communicating to the market the attributes of this acquisition. So a lot of people, that was their understanding, that it's going to take 10 years until the mine is actually operating. It's not, in fact, the case. The deal that we did is on a piece of ground that is part of the overall Oyu Tolgoi deposit area in Mongolia, and the mine has been built, and the mine is up and running, and it is operating. It's just going to take approximately 9 years until that mining plan gets onto this ground on which our royalty is on. So it's not a situation where you don't know if the mine's ever going to get built because it's so far off. I know the mine has been built. It's just a matter of time until we actually get into cash flow. So I think that's one area that our investors had potentially misunderstood. And another area where it wasn't well explained is the structure of our transaction, which is if any part of the deal gets expropriated, because a lot of people are worried about the Mongolian country risk. And although I'm less concerned about the Mongolian country risk than most people are, we did ensure we structured the deal so that if any portion of it gets expropriated, we're entitled to that percentage of our money back from Entrée, so that Sandstorm shareholders aren't having to bear that same risk. I actually find it's a little bit ironic in the sense that right now the number one focus of most investors in the commodity industry is worrying, is the mine going to go insolvent? If they just invested in a mining company where the cost of production is going to be above the metal price. Well, the feasibility study for Oyu Tolgoi, that mine in Mongolia, it calls for them being able to produce copper at 81 cents a pound. And there are virtually no other copper mines in the entire world that are producing copper at 81 cents a pound. So the number one risk that our investors are fearful of today, which is the economic risk of the underlying deposit, we've now done a deal on one of the strongest economic deposits in the entire world. So hopefully this will work out very well for Sandstorm shareholders in the long run.
Very, very good, Nolan. And you mentioned this very briefly on the call right after the Oyu Tolgoi deal was announced. Does Rio Tinto have a more aggressive plan that they haven't announced to perhaps develop your portion of that royalty sooner, like get a double, for example, like double the production of Oyu Tolgoi or increase it 30% or something like that, and get your portion mined in only 5 or 6 years or something like that?
Right now, Turquoise Hill, which is a company that's owned or controlled by Rio Tinto, they are working on a plan right now, so I'll reserve judgment until I actually see the plan. But certainly the initial plan calls for mining of material in the north of the deposit, and we think that eventually there's a reasonable scenario where they also sort of two-track it and mine material on our ground to the south of the deposit, and you could sort of get a double whammy there and significantly more cash flow than is currently in the studies. Okay,
very, very good. I think that would be very beneficial news. Because that's one of the major issues is that people don't want to, because your business model is under 3 years for a stream to come online normally, and now I think you've pushed that timeline even closer. I think it's 18 months. I think Denver told me. And, waiting 10 years for something, even though it's going to be amazing, is a long time in this type of market where people are chasing dividend yields. For my next question, though, Sandstorm Gold, Silver Wheaton, Royal Gold, and Franco-Nevada are now arguably the best financing option for near-term producers as debt and equity markets evaporate for miners. The terms are sky high. It's insane to dilute when shares are already down more than 70% in some cases. Is Sandstorm Gold getting an increased amount of deals brought to it at better terms than in the past?
It is. There's sort of two things going on. One, our existing deals that may have been there before, they're now coming to us on better terms than they would have come to us before. But there's sort of a second thing that's going on, which is companies that had such good quality projects before, they could raise seemingly unlimited amounts of equity, and they did not need a stream, and they were not going to do a stream. Today they need a stream, and so we're able to sort of upgrade the quality of assets that we're doing deals on as well, and we're looking at some fairly interesting deals that we probably would not have been considered as a financing alternative even 2 years ago.
I want to shift gears here and talk about Sandstorm Metals and Energy, which is a company that a lot of investors are now focusing on if you compare it to Sandstorm Gold. So I want to try to get a quick update on what's going on with Sandstorm Metals and Energy. I believe pretty soon that you have a copper stream that's coming online this year. Is that correct?
That is correct. We just announced last week that the first ore was put by Xstrata through the mill. I believe that happened last Wednesday, and it takes a little while to actually get various concentrates produced and shipped out, and then you've got a long quotational period until you actually get paid for it by a smelter. But by the end of this year, we anticipate getting our first checks from the copper on the Donner stream, and the second stream that we think is going to start cash flowing should be at the end of 2014 the Colossus stream with the palladium on the Serra Pelada asset in Brazil, and we're hopeful that that will be seen by Sandstorm shareholders as a very, very positive thing, and we're hoping our share price will react. And at the same time, we're now focusing on growing the business again. We're starting to look at high-quality deals. This market is bringing a lot of opportunities to us that are better and stronger than they were before.
Nolan, are any companies actually in production approaching you now because the debt and equity markets are bad for them too, like someone like a Brigus Gold type deal where they have a hedge book or something like that? Are you getting any type of action negotiations in that case where a company needs a little bit more capital and then they can't raise it and they're coming to you?
We have been approached by a few currently producing companies. We have not done a deal with one as of yet just because so far the companies that have approached us, I don't believe they have a low enough cost of production to survive if the commodity prices continue to go downward a bit. And so we're being fairly conservative there. I think it's probably, I would say, 30 to 50% chance we end up getting a deal done on an actual currently producing asset.
Well, Nolan, I appreciate your time, and thank you for coming on for a podcast. If people want to find out more about Sandstorm Gold and Sandstorm Metals and Energy, could you give out the URL to the website?
Yeah, it's sandstormltd.com.
Okay, great. Well, Nolan, thank you for coming on, and hopefully we can come on in the future. And good luck for the rest of the year.
Well, thanks for having me, gentlemen. I appreciate it.
Thanks, Nolan. And for our listeners out there who are investors or consider adding shares of Sandstorm Gold and Sandstorm Metals and Energy, this is a management team that has under-promised and over-delivered. They're very conservative. They do months and months of work on their deals. Management, we've been invested in this company for over 2 years, and management has done what it said it was going to do. And these are very capital-efficient businesses in a highly capital-inefficient industry. So our listeners should definitely, these are bargains here. I think this is very similar. Buying Sandstorm Gold at these levels is similar to buying Silver Wheaton when it dropped to $3 in 2008.